Hello, everyone, and welcome back to another episode. I'm your host and millennial investor, and today I wanted to share with you guys the small change that I just made in the portfolio. This pie that is shared in the description is already shared down below in the description, so check that out if you want to see that. But I no longer have that 1% holding in AT&T. AT&T stock is one of the only two stocks since starting this portfolio back in April that I've actually sold for a loss. With you guys that know me, I do not focus on share price. That is not something that I pay attention to. I focus on the business model. I focus on the aspects of the business and where they're going in the direction of the company and where they're looking to be in the future. Now, AT&T did not fit that criteria. I think I got swayed by a lot of dividend investors by looking at that 7.6% dividend yield and even more than that today after today's drop. But I ended up selling my 1% in AT&T and ended up buying 1 more percent into a stock that I've been talking a lot about. And I mean a lot about. Over the last 2 or 3 months, I think it is extremely undervalued at these levels. WP Carey. WP Carey is a real estate investment trust, and I want to just go over very quickly a couple of the basics between these two companies and show you guys why you might be interested in doing the same. If you follow along with me in my investments, if you copy my portfolio, if you copy my investing strategy, I think that these two companies are very important dividend stocks to talk about, and I think that WP Carey has more upside potential with better dividend opportunities in the long run than AT&T does currently at these prices. But thank you guys so much for joining. If you're not familiar with me, my name is Jordan. I'm the millennial investor. I track my annual and monthly dividend income on these charts, as well as my portfolio value and my monthly YouTube income. And whether it be Friday's video or Monday's video, I will be updating these 4 charts, getting the new monthly updates in the next video or two. So if you want to stick around for that, I invite you to subscribe and follow along with me to that. But if you haven't followed me before, if you want to support the channel, one of the ways you can do that is go ahead and sign up for M1 Finance, and you can get $10 just for signing up when you deposit $100 to the platform. 51 people have signed up. Let's go ahead and try to get that number to 52. I really appreciate all the support that you guys had. And like I said, lots of other things to check out in the description as well, including Yada savings accounts, credit card referrals, mentoring calls, all different types of stuff like that. But thank you guys so much. And let's go ahead and dive straight into the video. And first, I want to go ahead and start with AT&T. Now, I want to compare HBO Max compared to the other streaming services. Now, AT&T has a Goliath business, being their telecommunications business, where they get billions of dollars worth of cash flows from their telecommunications business. Now, the one problem with that business is that there's not a lot of growth there. They don't really have a lot of opportunities to raise prices, and they pretty much compete with all of the other main competitors out there, like Sprint and T-Mobile and all the other big names out there like you've heard of. Now, the one bright spot, the one area of growth that AT&T could really shine is with the fact that they own HBO, and they just released HBO Max very recently, their new streaming service. Now, HBO Max has pretty much been a botched launch. They have not gotten nearly the subscribers that they should have. They didn't offer it to Roku and some other platforms as well, and basically people have not been able to subscribe to HBO Max as fast as a lot of their other competitors have. Now, considering the billions of dollars that have been poured into HBO Max, let's compare this to Netflix, Amazon Prime, Hulu, and Disney+. Now, Netflix has 29.3% of the top 5, 24.8% going to Amazon, 17.4% going to Hulu, 7.9% going to HBO Max, and then 6% going to Disney+. And Disney Plus is a brand new streaming service. And by now, I think this chart is actually a little bit older. I think by now, this chart is actually lopsided. I think Disney Plus has actually surpassed that of HBO Max. But regardless, you see the mass difference here between HBO Max and the type of growth that they're getting compared to the other top players out there. And I just want to show that management is not putting the type of emphasis on this as a lot of other companies are. Now, once again, I want to compare this to a lot of the other big names out there, Netflix, Hulu, Amazon, Apple TV is also in here as well as Disney Plus, and you can see the price differences here. Notice that the highest number on this list, with the exception of Netflix Premium, is HBO Max. They charge a lot for their high quality premium content. Now, basically, they offer all different types of things throughout these streaming services, Netflix being the shotgun approach where they come out with new content pretty much every single day. And then there's things like Disney Plus, which is very family-friendly content. And then there's HBO Max. Basically, theirs is very gritty, very adult content, and it is very high quality. So when they come out with a release, they spend hundreds of millions sometimes producing just one TV show, and maybe even sometimes with a thing like Game of Thrones, they might even spend billions to produce it. But that's why they offer a high price target, but it doesn't really incentivize a lot of subscriber growth with that higher price model. But let's keep going. HBO Max has a 28.7 million subscriber base with HBO Max, but not all of them are actually watching it. This was October 22nd, so a few days from the time I'm filming this. HBO Max, the new premium streaming channel from AT&T's Warner Media, said its earnings report on Thursday that 8.6 million customers have activated their subscriptions to their service in the third quarter, bringing the total HBO and HBO Max subscribers to 38 million, ahead of the company's target 37 million by the end of 2020 and 57 million globally. AT&T counts activations as well as subscribers, as many customers who already pay for HBO have access to HBO Max as a part of their package, but haven't yet activated the subscription and started watching. According to the earnings report, 28.7 million customers were eligible to get HBO Max at the end of the third quarter, but activations on HBO Max were 12.7 million. So basically, the people that have standard HBO packages are eligible to get HBO Max and either don't even know about it or do not care about it enough to even enroll in HBO Max services when they already have it paid for. So let's keep on going further. AT&T trying to sell DirectTV again. Now, this is one of the few positives, I guess, that the company has out there, is that they're trying to sell DirectTV, but quite frankly, nobody seems interested in buying. AT&T considered selling off its troubled DirectTV unit. The pay TV satellite service brought in $49 billion in 2015, but today it could be valued around $20 billion, so less than half of what they bought it for 5 years ago. In the last 5 years, it has lost over half of its value. And even at these prices, at $20 billion, they can't find anybody to buy it. Not Dish Network, not anybody. No one is wanting to buy DirectTV. So overall, you see the pattern here from lagging subscriber growth, from high price models, from AT&T not really being able to grow its telecommunications business, from HBO Max not really being utilized the way it should be, and then just overall, the company does not have the best management out there. Now, there's one good thing and one good thing only about AT&T, which is one of the reasons why I invested in it. They have a great dividend yield and a great dividend track record. But eventually, I don't know if that'll ever be cut in the future, but this is not the point that I want to focus on. What I care about is that the company and the management behind this team is not quite effectively doing things the way that I would like them to be. So overall, I just want a company that I want to be moving away from, and I want to be focusing my funds towards a company that I think is extremely undervalued at these levels. I really like WP Carey. So let's go ahead and close out of all these articles for AT&T, and let's shift to WP Carey. Now, before I showed you the things like their highlights for their portfolio and the bullet points for this company, I wanted to show you some of the recent news articles. These have all came out within the last month or so, and you know how we read all these negative articles about AT&T, their lagging subscriber growth, their horrible DirectTV business, that type of stuff is coming out daily. Well, look at the type of reports that WP Carey is coming out with. They have rent collection rates of 96% for the second quarter of 2020 and 98% in July 2020. Now, these are the most recent earnings. They do come out with earnings about a week from the time of filming this video, so we can get new updates coming out in the next week or so. But look at these numbers. 98% for the month of July. 98%. Now, remember, the second quarter of 2020 was the worst quarter in GDP in the history of the United States. And even in the worst of all quarters for the United States, they're still getting 96% of their funds, so doing very well throughout this recession. Let's look at a couple more articles. WP Carey increases quarterly dividend to $1.44. Well, guess what? They've raised their dividend 3 times in 2020. Not once, not twice, 3 times, and they're on track to raise it a 4th time. They raise it every single quarter like clockwork, and when you're getting 4 raises a year instead of 1, it lets you compound those shares even faster. Now let's keep on going further. Let's go to this last article. WP Carey announces $44 million industrial property investment. You see how they're investing in their properties. They're raising their dividends. They're collecting pretty much all of their rents, even in the worst of economic times. And overall, I just think this makes a recipe for an incredible opportunity for investors. Now, I just want to show these bullet points in case you haven't seen them before. I've showed them many times on the channel because I absolutely love this company. I've shown it so many times. Just a quick bullet points. Their average lease term is over a decade long, almost 11 years. Almost 99% of their properties are occupied, split between 1,216 different properties and 350 different customers. Now, they have almost all their rents contracted out to where they can raise them almost every single year because a lot of them are CPI based and uncapped CPI based. So they can raise those rents almost every single year. Let's keep on going further. Let's look at diversification. Geographically, it's about 2/3 in the United States and about 1/3 in Europe and then 2% in the rest. And they're diversified between multiple different properties. So like, for example, people who invest in realty income. People who invest in realty income are nearly all entirely investing into retail. They have industrial, warehouse, office, retail, self-storage, and other. Not one sector makes up 25% of their property types. And then we go to tenant industry and diversify between all different sectors. So I think with the mass amounts of diversification, raising dividends, a 6.5%+ dividend yield, and they're down 4% today. So another buying opportunity once again. And I think that this company just provides an excellent opportunity for shareholders. And buying this company now, considering the fact that they are getting 98% of their rents, and this was a $90+ stock just a year ago, this provides an excellent opportunity, and I think my funds are better put in WP Carey, and I think in the long run, this is going to provide an excellent way for me to create shareholder wealth. So thank you guys so much for watching, made all the way to the end. Like I said, if you want to support me and the channel, links are going to be down in the description for referrals to M1 Finance, for other brokerages, as well as things like credit cards, savings accounts, mentoring calls, all that stuff. But go ahead and check all that stuff out down below if you haven't already. Go ahead and subscribe. I'd invite you to do so if you haven't already. I'll be updating these charts in just a video or two. So if you want to follow along with me, go ahead and subscribe to the channel. If you have any comments, go ahead and leave them down below. I'd love to answer any questions you guys have down below. But thank you guys so much, and I'll talk to you guys next time.